Do you want to grow your wealth faster or earn passive income without lifting a finger? Well, it depends on your age and investment strategy. If you're in your 20s, 30s, or even 50s, your game plan should be very different. But most investors make a huge mistake. They invest the same way at 25 as they do at 50. Today, I'm going to break down growth versus dividend investing for Singaporeans. No boring financial jargon, just clear and practical steps to help you reach financial freedom. And if you stay till the end, I'll reveal the perfect investment mix for your age, so you won't make costly mistakes. Before we start, smash the like button and subscribe to WealthForYou. That way, YouTube shows you more money-making content to grow your wealth. Now, let's dive in. Before we begin, a quick disclaimer. This video is for informational purposes only and should not be considered financial advice. Always do your own research or consult a licensed financial advisor before making any investment decisions. Section 1. The big question. Growth stocks or dividend stocks? Let's start with the basics. There are two main ways to make money from investing. 1. Growth stocks. Stocks that increase in price over time. For example, Meta, Alibaba, Amazon. 2. Dividend stocks. Stocks that pay you money regularly. For example, DBS, OCBC, CICT, CFA, which is an ETF. Growth stocks are like planting a seed that grows into a huge money tree over 10 to 20 years. Dividend stocks are like owning a chicken that lays eggs every month. You can eat the eggs, income, or reinvest to get more chickens. So which should you focus on? That depends on your age and goals. Let's break it down. Section 2. Young Singapore investors, 25 to 35. Focus on growth first. Your goal is to maximize growth and build wealth fast. At 25, your biggest advantage is time. Your salary is just starting to grow, and you have more than 20 years to invest before retirement. Your game plan. Focus on growth stocks because you can afford to take more risks. Invest in tech, innovation, and emerging markets. Think Google, Microsoft, Alibaba, Amazon, Apple. Use dollar cost averaging, or DCA. Invest a fixed amount every month, no matter what the market is doing. Consider Singapore growth stocks too, like C Limited or strong REITs that reinvest aggressively. Example: you invest $500 per month into growth stocks. After 10 years, at 10% growth per year, your portfolio is worth $103,000. Why? Because growth stocks can increase 2 times, 3 times, or even 5 times over time. What not to do? Don't chase hot stocks randomly. Stick to quality companies. Don't be scared of short-term crashes. Growth stocks are volatile, but time in the market beats timing the market. When to start thinking about dividends? Once your portfolio reaches $100,000 or more, start shifting some money into dividend stocks to create passive income. Section 3. Older Singapore investors, 36 to 55. Shift to dividend stocks. Your goal is to build passive income and reduce risk. By now, you probably have a stable salary, more responsibilities like family and mortgage, and a growing investment portfolio. The mistake many make? Still investing like they're 25. At this stage, you want to start collecting passive income to cover expenses. Your game plan. Focus on dividend stocks and REITs, for example, DBS, OCBC, CICT, and Mapletree REITs. Aim for a 5 to 7% dividend yield. This means for every $100,000 invested, you get $5,000 to $7,000 in yearly passive income. Continue some growth investing, but rebalance your portfolio, for example, 60% dividend stocks, 40% growth. Example: you build a $500,000 portfolio with an average 6% dividend yield. That's $30,000 per year in passive income, enough to cover your car loan, bills, or even a simple lifestyle without working. Your ultimate goal? Have more dividend income than your expenses equals financial freedom. What not to do? Don't only focus on dividends too early. Growth stocks still have a place in your portfolio. Avoid chasing super high dividends above 10%. They often come with big risks. Section 4. The ideal Singapore portfolio. Balance both. The best approach? Mix growth and dividend stocks. Adjust based on your age. At 25 to 35, 80% growth stocks, 20% dividend stocks. At 36 to 55, 40% growth stocks, 60% dividend stocks. At retirement, 55 and older, 80% dividend stocks, 20% safe bonds and growth. Conclusion. What's your next move? If you're 25, this is your golden window to invest in growth stocks and let time do the heavy lifting. The earlier you start, the more your money compounds and multiplies. If you're 45 or older, it's time to shift focus. Build your dividend portfolio so you can enjoy passive income while reducing investment risks. The goal? Let your money work for you, not the other way around. The most important lesson? Start now. The longer you wait, the harder it gets to reach financial freedom. Whether you're chasing capital gains or passive income, consistency is what builds real wealth. Which strategy fits your age and goals? Are you team growth stocks or team dividend stocks? Drop a comment below. I'd love to hear your thoughts. If you found this video valuable, smash that like button, subscribe to WealthForYou, and turn on notifications for more Singapore-focused investment strategies. See you in the next video. Your journey to financial freedom starts today.